Here's a quick review on how to handle interest-bearing and zero interest-bearing notes. So just some easy numbers here. The note is worth $100,000. It starts on March 1st, 2017, has a time of 4 months and an interest rate of 8% per year. The entry is simple. You're going to debit cash for the $100,000 received, and you're going to credit notes payable for the $100,000 that is owed. Now, given that we already know interest is principal times rate times time, and so we end up with $100,000 principal times a rate of 8% times 4 months out of 12 to get everything in the same time frame, we know that interest is going to be $2,667. So the entry to record interest is a debit to interest expense at $2,667 and a credit to interest payable at $2,667. So when we go to pay back, we end up paying $102,667. And the entry is a simple entry, debit to notes payable to get that off the books for $100,000, debit to interest payable to get rid of that liability for $2,667, and a credit to cash for the amount paid of $102,667. So, how do you handle it if there's a stated interest rate of 0? It's really built into the note because the note's for $153,000. But the present value of the note is for $150,000. So you can see that interest is already built in. One of the ways to handle it is a debit to cash and a credit to notes payable for the $150,000. And you're going to keep this on the books at its current amount, which is the liability for $150,000. When you go to record the interest expense, and you know it's $3,000 because it's the difference between the value of the note at $153 and the present value of $150. So you're going to debit interest expense. For $3,000, record the expense. You're going to credit notes payable because you're increasing the liability. You're now liable for the $153,000. Then when you go pay it, you're going to debit notes payable for $153,000 and credit cash for $153,000. And you've accounted for everything properly. You've accounted for the note at the fair value, the amount that you're expected to pay. You accounted for the interest expense, so that's all acceptable. There's another way to record the note as well, and that's a debit to cash because the amount received was $150,000, a credit to the note payable of $153,000, and a debit to the discount on notes payable. And your note would be shown at notes payable of $153 less the contra liability of $3,000, so your net value you're going to show is $150,000. Then, when you go to record the interest expense, you're going to debit interest expense and credit discount on notes payable. That will eliminate the discount on notes payable and properly account for the interest expense. And when you go to pay the note, you're going to debit notes payable and credit cash for $153,000. All of those ways are acceptable.